Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio, and today we'll focus on investing in exchange traded funds. To understand what the ETF market in India is like, how do the ETFs in India compare with global ETF markets, what is the risk associated here, what are the growth levers going forward, we have Siddharth Srivastav, Head ETF Products and Fund Manager at Mirae Asset Investment Managers, and Tarun Birani, the founder and CEO at TBNG Capital Advisors, joining us now on the show. Gentlemen, good afternoon. Thank you so much for joining in. Well, ETF, there have been a lot of changes that we've seen recently. It's the big buzzing word as well. So let's try and understand that first up. Tarun, let me begin with you. How big is the ETF asset class size in India? How does it compare with global ETF markets?
Good afternoon, Sonal, and thank you for having me on this show. And just to give you a quick background about the Indian ETF market, this is growing significantly with ETF or indexing constitutes now almost 13% of almost mutual fund industry AUM, approximately like 10 lakh crores right now as we talk. However, compared to the global ETF market, which has surpassed almost like $10 trillion in AUM. Indian ETF, it's still, I would say, is at a nascent stage. Again, this disparity highlights the enormous potential of the growth as Indian investors increasingly adopt cost-effective indexing and ETF ideas and building a more diversified exposure in the markets.
Okay, all right. So that is what the difference is looking like. Tarun, coming to you, we talk about ETFs seeing that growth, but is there a specific category or which amongst the ETF basket is seeing the highest traction? Are we seeing better traction in commodities, or is it still the equity ETFs that people are looking at?
So I think as an asset allocation strategy, we have 3, 4 asset classes: equity, debt, gold, right? But if I look at from a indexing and ETF, I think equity is driving the growth in the indexing market or the ETF market because it is considered to be more cost effective and again ease of access to diversified equity exposure. So from that point of view, equity is the first. Then gold is also getting a lot of traction. It has given a great vehicle to a lot of investor. Instead of buying physical gold, you can actually build exposure through gold ETFs. And I think debt ETF, I would say, still gaining traction, but it is still very, very nascent in India. And times will tell if we can find this category has become large. But globally, debt is also a very, very large category in ETF. So I think equity continues to be the highest in the traction right now, I talk about.
Okay, so equities, that continues to be the big focus point. Whenever we talk about returns, we have to talk about taxation. And like we've said, globally, ETFs have more traction than what we are seeing in India. So in terms of taxation, Tarun, let me come to you. There is a difference in US ETFs and Indian ETFs. How does it work? We have some withholding tax. There's something on dividends as well, if you can explain that.
Right. So let me first come to Indian ETF, and I think that's pretty straightforward. If you pick up Indian ETF or Indian index funds, the long-term capital gains are more than 12 months is 12.5%. Again, you have exemption limit has been increased to 1.25 lakh rupees now. Again, short-term capital gains are similar like direct equity, which is 20%, up from 15% in the last budget. Again, coming to non-equity oriented ETF like gold, international and all, the long-term capital gain more than 24 months is taxed at 12.5% with no indexation benefit available now there. And again, on the short-term capital gain, it is taxed at the marginal tax rate of the investor. Now, let's come to the US ETF. Again, Indian investor can pick up US ETF through two mechanisms. One is through a LRS route, which is subject to 2.5 lakh dollars per year per account can be invested, which is again subject to TCS of almost 20% deducted at the time of investment. But there, in that structure, you have a long-term capital gain, which is for more than 24 months is taxed at 12.5%, and short-term capital gain, it is applicable at the slab rate. Again, there is one very unique structure. And again, dividends is subject to 25% withholding tax in US, offset against the Indian tax liability under the DTAA, subject to the country we are investing. And coming to another mechanism which Indian investor can use to invest in, let's say, US equities or US index funds is through fund of funds. So we have a lot of funds mirroring the NASDAQ, S&P 500, and many such structures. And these funds, more than 2 years, is available at 12.5% in tax rate. So according to me, these are very good structures for Indian investors, and that could be optimized for them. Yeah.
Okay, all right. So that's about the taxation bit. Tarun, coming on this, the same question, some of the risks that you think are there with this asset class, and how much should ETFs be a part of the portfolio?
So I think the first question, Siddharth, clarified very clearly, and I will just summarize those. First is market risk. Again, underlying asset and market movements risk continues with ETFs. Tracking error, I think difference between the ETF returns and the benchmark index performance. And the third one is the liquidity risk. I think Indian market is still at a nascent stage, and many ETFs currently doesn't have the adequate liquidity. So in times of correction or markets turmoil, at that point of time, we have seen liquidity becomes a challenge. So I think investors should take a very, very informed decision whenever they look at that. One another way to manage this is to go through an index fund route. The index fund route, you don't have a problem of liquidity because there, I think the fund actually buys and sells from you. So there, it's like a normal mutual fund. So again, investor hesitation often stems from lack of awareness about ETF as well as traditional preference for active funds. So that has been the big reason. Now, I think on your question about how much ETF should be part of investor portfolio, I think I will go a little deeper in this and go more from a financial planning perspective. I feel it can be 100%. Indexing or ETF can be 100% of your portfolio. Why 5%? Why 10%? I think it can, because you actually have all the asset classes available, right? From debt, equity, gold, all the real estate. Also, I think innovations are happening there. So actually, I think indexing or ETFs can actually take care of the entire portfolio for the client. I think from a objective basis, again, it can be core allocation for diversification. Again, cost efficiency is there, flexibility in portfolio design. But let me start with a conservative portfolio. If anybody wants to build a conservative portfolio with capital preservation with moderate growth, I think bond ETF, balance ETF can be picked up because that will give them the conservative approach. For a growth oriented investor, you have indexes and ETFs which can track equity, sector thematic indexes, international ETF. Again, this can be like 50 to 70% of the portfolio. For retirement planning perspective, again, these indexes and ETF can be used for income generation, and equity indexes can be used for inflation adjusted growth that can help build sustainable corpus. Again, for short term goals, bond, money market, index, ETFs, and all that, which again is a nascent stage in India. But as the time will come, in US, you are seeing a lot of traction there. Again, the big advantage of ETF or indexes in financial planning, when I look at for my client, is transparency, liquidity, rebalancing, flexibility. Again, in active fund manager keeps leaving jobs. Again, here you don't have any problem. You are buying the market. So it gives me a lot of visibility for portfolio growth. Yeah.
Okay, take that point. That explains your insights as well. So that would have asked you the same question, but we are completely out of time. But keeping it for the next time. Thank you so much, gentlemen, for joining in today and giving us all those insights and expertise on what's happening with the ETF market. With that, we'll take your leave on this edition of MF Corner.